Welcome back. A warning for investors in this week's Wall Street Journal. An op-ed this week titled "Stocks Headed for a Fall," appearing in Wednesday's paper, saying rising interest rates could trigger declines. Joining us now, the author of that op-ed, Martin Feldstein, is here right now. Harvard professor, former Council of Economic Advisors chairman under President Reagan. Great to see you, Marty.
Good to be with you.
Thank you so much for joining us. So how significant a fall might we be looking at?
It could be very big. I mean, the market is up so much, driven by the Fed. Now the Fed is reversing. It's pushing up interest rates. It's undoing the big buy of long-term bonds. So I think as interest rates rise, we could see the stock market go back to a much more normal price-earnings ratio.
But you're saying driven by the Fed. I mean, just since the election of Donald Trump, this market's up $7.5 trillion in value. What do you think about monetary policy going away? It's been so easy, and fiscal policy sort of taking the lead here.
It's not going to do it. I mean, the news about the advantages of the tax bill are in the market already. The real problem is going forward that we will see a rising interest rate for a lot of reasons, not just the Fed, but the fiscal deficit will push up long-term interest rates as well.
Will we know it when we see it? When the market starts to turn, it's going to happen real quick, do you think, or?
It always happens faster than you think. So all the guys
what's the trigger? What's the trigger?
Trigger is people wake up and say, well, maybe I ought to get out. And enough people say that, and the market moves.
But to Maria's point, and your op-ed is great, but it paints a very, very bleak picture. I read it and was sort of downcast for half the day after reading it. But is it not possible that there could be an unwind of the balance sheet and there could be a rising of interest rates in such a way that doesn't trigger a downturn in the market? Can this be done in a soft, steady, gradual way?
Well, that's what the Fed hopes. That's what I hope. But I think if interest rates really do go back to, quote, normal, so we see a short-term rate that moves up a couple of points, if we see the long rate go from 2.5 to 4, 4.5, it's hard to believe the stock market won't notice that.
But you've got the tax cuts on the table. We haven't talked about regulation yet. Some people would say you're underestimating the ability of businesses and the economy to move forward because you have the juice from the regulation.
Right.
You have the juice from the tax cuts.
Well, this is a really important point that you're making. The regulatory rollback is being talked about as one of the big movers of the stock market and the economy.
And I certainly believe that it has done that. It has contributed to it. But if you look at what the price-earnings ratios are relative to the past, they're up dramatically relative to where they've been historically. Some of that you can, and they've been there even before the Trump victory.
Well, let's look at the numbers here, because earnings are expected to be up 23% in 2018. Compare that to valuations. 23% for the S&P 500 is the estimate.
So where is the S&P for PE is about 24, and where was it historically? Around 16.
You're talking backward, 24. Okay, because forward is about 17.5 to 18. 18 times earnings if you look forward earnings.
If that's,
I'm just saying, right? But, the PE going forward for 2018 would be 18, and the markets and earnings is supposed to be up 23%. But I mean,
But it's probably true that if you went back historically and you did forward-looking PEs, they were always lower than the historic actual backward-looking PE. So I think you can't compare the historic number
to the forward.
To the forward.
So you're talking to a bunch of people who want you to be wrong, basically.
Well, those 401k holders.
He doesn't want to be right. It's not like he's rooting.
Yeah, no, absolutely not.
I think the real problem is what happens if there is this downturn.
Right.
And the Fed doesn't really have the ability to offset it.
Downturn in the market or downturn in the economy?
In the economy. But if we get a big downturn in the market, consumers are going to respond negatively and businesses are going to respond negatively.
But, Marty, where's the downturn in the economy? I mean, we're talking about 4% growth.
It's not there now. It is certainly not there now.
So you don't think the economy is as strong as people are making it out to be? The underlying economy.
No, I think the economy is fine as long as the market doesn't turn down. If the market turns down because of higher interest rates, or because of external events. If the market turns down, then that will push us off this very nice path that we're on.
You must have one piece of good advice for policymakers and how they can handle all this, how they can manage all of this.
How do you deal with this?
I think they have to look beyond the Fed. I think the Congress and the administration has to say, what will we do if the economy turns down? Because the Fed is not going to be in a position to cut rates substantially.
Is there any other stimulus away from the Fed that can be put in there?
It's called tax and spending policy.
So it's really spending, because tax policy we've got.
We've got that.
Yeah.
Yep.
So it's
and it
pulling
has
in
to
on the
be
spending.
Right. Right.
Marty, it's great to see you.
Good to be with you.
Thank you so much. And you weren't
Glad
all
to hear
Dr.
your
Doom.
optimism. No, no. No, I wish I had a different picture about what the risks are. But I would say the economy is in great shape, but very fragile.
All right. Marty Feldstein joining us there. We'll see you soon, sir. Thank
Good
you
to
so
be
much.
with you.